Let's see an example of cash flow projections in Microsoft Excel. What you see in the upper part of this chart is a monthly income statement, which is based on the budget and assumptions explained in the prior video. To simplify this chart, I consolidated all operating expenses under selling, general, and administration expenses. Also, I am not including any non-operating expenses such as interest paid. In the lower part of the screen, you will see the cash flow projections. Let's start with a monthly income statement. I cut this chart in May, but it needs to cover 12 months. Every month, starting in January, you will see that there are 3 columns: projected in blue color, actual in black colors, and column in yellow shadow. That shows the difference between projected numbers and actual numbers. Look at projected sales in January is $40,000, and this number comes from the calculation we did in the prior video. The projected number is actually higher than the actual number. The difference is a negative $2,000. What happened? Perhaps less customers came to the store, prices were too high, customers purchased less, or the store didn't have the products needed by the customers. If you monitor sales every month, projected versus actual numbers, that will allow you to make timely decisions to correct any issues. If you look at April expenses, you will see that actual numbers, $15,707, is higher than the projected numbers. In this case, you can analyze why you spend more and whether it helped you increase your revenue more than the expenses. If not, you could replace or eliminate the expenses. It has to make sense for your business. Every expense that you make, it has to contribute to generate more revenue. Let's look at the cash flow projections in the lower part of the screen, and you will see how your operations affect your cash position. In January, it starts with the initial balance in your business bank account, $20,000. To this number, you will add the projected revenue of $40,000 and deduct the costs and expenses, plus the compensation you expect to pay yourself, $5,000. Then you will see that your cash will decrease in $3,000. And look at what happened in the actual column. There is actually a higher decrease in cash of $3,480 just because your sales were lower. See that the ending cash of every column is going to go to the first row in the next column. In the case of projected, $17,000 ending cash will go to the initial projected cash in projected February, and the same with actual numbers. Let's assume that in April, your projections show a negative cash balance. Instead of positive $6,000, it will be a negative $6,000. So that means that before that happens, you will have to inject cash from your own savings before you run out of cash. As you see, cash flow projections are an important tool to control costs, monitor sales, and estimate cash needs. If you do this work in advance, you will never run out of cash because you will know when you have to inject cash either from your own funds or obtaining a business loan. It will also help you to determine short-term and long-term financing needs so you can secure good and timely financing.